Lots of people talking about HELOCs. Is it bad? Is it good?
This is putting dynamite in a kid's hands.
So what's the advantage?
It's basically doing to the bank what the bank's been doing to you the whole time.
What's your opinion on velocity banking?
Banks love W-2 employees more than they love business owners.
And I assume a HELOC would be easier to obtain than a business line of credit.
You have to, pee and bleed basically to find out if you qualify for the insurance.
Yeah. So is there an alternative?
Sometimes people spend optimism.
What have you used it for?
What I had used that money for before was buy a cabin.
As an individual?
Yeah.
Oh.
But I didn't use it to spend. I used it to acquire.
But probably the disadvantage would be the cash value has its own. Lots of people talking about HELOCs, good or bad.
Home equity line of credit.
What's your thoughts, opinions? How does it apply?
Depends. Are you a business owner or not? A business owner, this can be an instrumental tool. But there's 3 dangers. And if you don't address these dangers, it could be very problematic. And there's a priority that comes before you ever get a home equity line of credit. Now, should just anyone get a home line of credit? It depends. Do you spend too much money? Are you a bit of a train wreck? Do you not have enough control your finances? This is putting dynamite in a kid's hands. But for a business owner, this could be instrumental for growth, for protecting you, and for making sure you get where you want to go. But let's talk about some of the problems.
Okay.
The first one is a variable interest rate most of the time. So I think that the Fed's going to start cutting interest rates, so probably not as risky right now. Mm-hmm. But if you can get 15, 30-year fixed, it's nice to be at a fixed rate. The second issue with the HELOC is because it's a revolving, basically it's not like a credit card that if you borrow too much, if you borrow more than 20 or 30%, it can start to impact your credit score. So basically an installment loan is I get a car, it's a fixed period. Once I pay, it's done. I can't pull money back out without a refinance. A revolving loan, I can pay it down. I can bring it back up, down and up. That's nice for that flexibility, but it could impact your credit score. Now, if you have 800 plus credit score, probably not a big deal. But if you're on the borderline, it could actually start to cost you in your other loans. So that would be another thing. The third issue that I have with it is they could cut it. So let's just say that you have this home, right? And with that home, you've got $300,000 line of credit, but the market drops and you start to see defaults like we saw in 2008. Maybe they're telling you have 500,000 available. So you should, you have an $800,000 line. You've only used 300,000 of it, right? Mm-hmm. But the problem is they could just say, no, we're now going to cap it at 300,000.
Oh, gotcha.
Right. They just cut this out.
Yeah.
So that would be one of the issues is you think, oh, I've got this line of credit. It's kind of helping me with extra access to cash. It's a fund that I can use and jump into if the right opportunities come, or if there's some type of emergency or cash flow crunch or any of those kind of things. But if there's a major housing crisis like we've had in the past, they might lower the amount that's available to you.
And they don't have to give notification or anything.
They're going to give you a notice,
but after it's already done.
Yeah,
basically.
they're like, this is going to be cut.
Yeah.
This is not like you can hurry and go take that money out necessarily.
Yeah.
So you have to look at like a lot of the fine print, which most people don't. So the variable interest rate, if that goes up, that could be a risk. Revolving, if used too high of a percentage, the problem with that is it can actually impact your credit score, and they could just eliminate or cut, and lower the amount that's available to you. So that would be another problem. So what I like about them, number one, you can have interest only. So less of a payment. Number two, because it's a line of credit instead of something that's amortized, because amortized loans, because it's not that, then what happens is if you make payments, it lowers your payment.
Gotcha.
Right? So if I have an amortized loan, and I make an extra payment, it doesn't lower my payment. It shortens the time that I pay that off, but I'm still fixed into a higher payment.
Yeah.
So that's nice that you've kind of got that flexibility, right? Mm-hmm. That's one of the great things with it. 3, I could not use it and I'm not being charged any interest, right? So there'd be no charge to that interest, which is great. That's the 3 negatives and the 3 positives for the most part here. I think that it's really important, even if you have a mortgage, that you try to get a home equity line of credit, even if you never use it.
Gotcha.
And the reason is maybe that's the only availability to money when there's an amazing opportunity or when there's a major issue.
Yeah.
Again, you're not guaranteed to be able to get to that because they can definitely cut that out. I've seen it happen time and time again, but only during really difficult times.
Mm-hmm. Now, so is there an alternative that you try to approach that safety net with?
I use cash value in life insurance. So I use a properly structured, optimally funded whole life. What does that mean? A participating mutual company. So the policyholders own the company, one that's been around for at least 100 years, one that has always paid dividends, even those aren't guaranteed. Once they are paid, they become guaranteed. That basically have billions and billions in assets, that have all A, or A minus or A plus type of ratings from Moody's, Standards and Poor's, those types of companies. So that's what I do is I keep my cash in there because then I can always have my cash value continue to earn interest over time, but I still have the right to borrow against it. And they lend me their money while my money stays invested. So I have uninterrupted compounding.
But probably the disadvantage would be the cash value has its own investment phase, right? Versus the house is if you've already bought the
capitalization phase, right?
Yeah, okay. Better way to put it.
So basically that first year, I might be 50 to 80% of what I put in because there was insurance costs, right?
Yeah.
And so I'm at a deficit. The second year, it gets better, but it's still not at break even, right?
Mm-hmm.
It's not there. It's not quite at break even. So that's a problem. Third year, I'm probably starting to see more cash than what I add to it, but there's still a couple of years, that before I really get there because there's certain costs with it. Number one is that, you go through medical, you have to, pee and bleed basically to find out if you qualify for the insurance.
Yeah.
2, they've got to pay commissions and there's marketing costs, right? 3, they have to set money aside for the death benefit. So they have to have some type of reserve fund. And because of that, it could be a disadvantage. So I would recommend if you can get a home equity line of credit to get that, but not to have that be your main reliance for liquidity. If that's your main reliance, well, it has risk to it. Right?
Gotcha.
But it's still valuable and nice to have.
Are there any things that you look for when getting a HELOC? A lot of business owners aren't aware of.
One is there an introductory rate?
Okay.
Right. Versus what's the actual rate? And what, second thing, is there a cap? Is there a cap on the percentage that it can go up in any given year or total cap? Right. So that's something I want to know.
Oh, gotcha. Because it's variable. Is there a cap?
Because maybe they can only go up by 2% in any given year.
Okay.
And maybe there is a total that it would cap at. That's also a piece of it. 3, is there any prepayment? Sometimes you have to keep it for 2 years. And if you sell your house, then there's some type of penalty. Gotcha. Right. So you kind of want to understand if there's any limitations. I have one on this cabin. If I didn't keep it open for 2 years, there was a fee. But after 2 years, there's no fee. I could pay it down. I can take the money back out. But I had an introductory rate, and the introductory rate was 2%. But now the current rate on it is 8%.
Because it was variable.
Yeah, it's variable. And, I just got a line of credit. I wasn't even using it for the first few years in 2021. And then eventually it's like, yeah, I'm going to use that. And now it's at a much higher rate. So still 8%'s, not that bad considering what I used it for.
So do you, as a business owner, do you try to take out HELOCs on any of the assets that you own?
I have another cabin that I don't have a HELOC on. I've considered getting one.
To have it.
I've got one on here and I do not have one on my house. I made a 20% down payment on my house. It's gone up in value since I bought it. So now it's probably available. But at the time of closing, there really wasn't that much equity or a lot of home equity line of credits that would have been available. I mainly just use this one on the 3 properties I have.
Okay. So what's the advantage in terms of, for a business owner, what's the advantage of having a HELOC?
Well, the HELOC is you just get access to capital, and they'll give you a checkbook. So I like the ease of it.
Gotcha.
Right?
Because you can just write a check out of it.
Write a check. Very, very, very easy.
What have you used it for?
So I used mine to buy art. And so I took $75,000, put it into art. That art was actually worth a lot more than that. My art was worth about $300,000 because I bought 2 collections, which means after owning it for 3 years, I could donate it for the appraised value. And so I'm going to get $2 back for every dollar I spent.
Tax-wise?
Yep.
Okay, so it was a tax strategy.
Yep. And then when I had the lower interest rate, I had an 8% loan on my Guardian insurance policy. And so I paid that off, right? I took $400,000 and paid this off. What I had used that money for before was to buy a cabin. It was 3.5 acres. It was a small property, and I bought it for $880,000 in 2020. So what's that worth now? Well, I can tell you this, the land next to me, which is less than 1 acre. Okay. Less than 1 acre, just under, just sold for $435,000.
And there's nothing on it.
Nothing on it.
Jeez.
I have a cabin and 3.5 acres and the most riverfront. So you can see that was a good reason that I borrowed it and did that.
And so you're saying you borrowed it at 8%, but at the time your HELOC
I borrowed
was
actually
less.
at 2% initially.
Uh-huh.
And that's why I paid off the 8% cash value loan.
Gotcha. So the cash value was at 8%, but you got 2% on the HELOC.
Yep. So I used the HELOC to pay that off.
Oh.
And now guess what? It's 8% and the cash value is now down to like 6%. So it has flopped and I could take it out, but I've actually used the cash value for other things at this point. But I didn't use it to spend. I used it to acquire, you know.
Gotcha.
The art was a big tax strategy and something that you've seen when you've been to my house. And then also just, you know, using it for land acquisition, real estate acquisition.
Any other things that you know, either yourself or you've seen other business owners use a HELOC for to help?
Oh yeah, we've seen people use it. Like, I think a lot of business owners, it's really good because when you're starting out, having that line of credit could be good for payroll because sometimes there's just ebbs and flows of business. Yeah. Right. There's these big seasons and there's other seasons. And, you know, so when they're really trying to expand, they just have something that's really easy to access. And then they could just pay that back and they treat it almost like a little bit like a slush fund. Just pay it back when the business takes back off. And again, you're not trying to do big numbers with that. It's just kind of like to smooth things out. Or businesses, they'll expand in other ways, right? I've seen businesses buy equipment because a lot of equipment loans are like 15 to 18%.
Yeah, they're pretty high.
So it's like, hey, why not use this line of credit and get a much better rate on that, and interest only, which is extraordinarily flexible because if they have an amortized loan, it just might be a lot of cash flow problems, right? So I've seen them use it for that. I've seen them use a home equity line of credit to acquire a business. You know, one of the things is a lot of like SBA loans is what a lot of people will use when they're buying a business. They require a down payment. And so they'll use their line of credit for that down payment. So they don't have to take the money from the business, which is meeting payroll demands and expansion and all those kind of things. So, and you can acquire business for a similar down payment to a home quite often. That's, you know, my friend Walker Dybel kind of points out in Buy Then Build. So,
So is the HELOC in your name or does the business own the cabin? How does that work?
No, this one, the HELOC is it's a personal loan.
Okay. And then you basically just loan that to the business. Is that kind of how it flows?
I take money from the HELOC, right? I put it in the business account. It's a loan to the business. And the business will end up having to pay that back.
Gotcha.
So
as a loan from officer or something.
Exactly.
Okay.
We have to be careful with the variable nature. We have to be careful that they cut the amount that's available, right? We have to be careful with what that might do to our credit if we maximize it or use too much of what's available.
Gotcha.
Those are kind of the 3 big factors that I would really consider. But we also look at the flexibility.
Yeah.
Right? That's one of the great things. And you can use it for many purposes. It doesn't have like a, you have to use it for business or not use it for business. I really caution people not to borrow to consume. That interest only is really nice instead of amortized. There's just a lot more cash flow management that you could do. If you make a payment and start to pay it down, it's going to lower the payment. So that's great. I love that piece of it. It could be tax deductible depending on what you use it for. But, like if it's just against the home, depending on how much income you have and different things like that. And, there might be some tax deductibility of that. Obviously, anytime you use a loan for business, that becomes tax deductible. So you might even get tax deduction borrowing against the home and a tax deduction using it for business.
Yeah.
Right. So that could be very tax efficient and big tax benefit.
So go over just for business owners who are kind of not aware of some of the philosophies you teach. When you talk about don't borrow to consume,
if you're going to borrow money, make sure that you buy an asset. An asset is something that I want to be able to create cash flow for you. If you take some type of trip that you've been wanting to do, but you borrow money, and now the trip's over, you have no asset, but you still owe money. So that's a problem. I'm talking about don't use it for depreciating assets either. Some are just not assets at all. They're just consumption, right? So depreciating asset might be like a jet ski. Might be like I have a Can-Am. These are just toys that could be, as Rich Dad calls them, doodads.
Yeah.
Even cars quite often. I mean, there might be some exceptions to the rule. I think, why not use it for cash flow? Why not use it for something that's going to put more money in your pocket when you borrow versus borrowing and having nothing to show for it, and now you have debt. Yeah. That's the issue.
Gotcha.
And that's, I guess, one of the things is sometimes flexibility is a problem because the money's available. And sometimes people spend optimism.
Gotcha.
They go, hey, look at this. I can just borrow and I could pay that back down the road because I'm going to have a good month because last month was really good. I've been guilty of this, Weston.
Yeah.
Just thinking, oh yeah, I've got this coming in, and then it doesn't come in. Something changes, some anomaly. You're like, oh crap, I was kind of like spending it before it came in.
Yeah.
And so never borrow to consume. Think more like a bank. They don't take your money and consume it. They take it and they allocate it towards cash flow.
Yeah. Because I feel like most people use a HELOC for, home renovations or something like that.
Right. And that doesn't necessarily create cash flow.
Yeah.
I mean, I'm not saying that that's, depending on the renovation, it's maybe not the worst spending of it, but it is going to increase your payment.
But as a business owner, there are things that a person could do that would be much more effective in producing cash flow.
Right. Again, use it as kind of that, because you're going to have ebbs and flows in business. So you can use it as part of your liquidity, part of your accessible funds, right?
And I assume a HELOC would be easier to obtain than a business line of credit.
It depends on how established your business is.
Oh, okay.
If you're a new business, it could be a little bit harder, but banks love W-2 employees more than they love business owners.
Yeah.
They like to see how much money you have in an account. They look at that as seasoned funds, right? Because they want to know, do you have money in case something happens? They want to see how consistent your income has been.
Yeah.
And a lot of business owners have income that is all over the place, right? So that's kind of another issue. But yeah, business credit is usually something you develop over time, where you already have your personal credit. And if it's good and you maybe have a spouse that's working, a home equity line of credit is going to be a lot easier to obtain than a business loan for the most part.
Yeah. But also if we're talking about
typically better interest rates too.
Yeah. Yeah. If we're talking about someone in an LLC where they own the business, but they're getting paid as a W-2 employee within that business.
That still helps.
Yeah. Because then it's they most likely could get a HELOC.
Again, they're looking for that existing cash flow, that consistent cash flow.
Any tips or suggestions on how to look your best to get a good HELOC?
So the first thing is credit. If you're 760 and above, that's really helpful.
Okay.
Part of why you're getting a good interest rate is because you have collateral, right? So collateral depends on how much equity is in the home, right? The more equity, the better that's going to look. If there's not much equity, they're not that interested in giving it to you. Your cash flow reporting. You know, what are you giving them? So when you have taxes that are clean, when you have funds that are, you know, available and kind of been sitting there for more than 3 months, that's another big thing. When you can show them a clean income statement, that's helpful, right? A clean balance sheet.
As an individual?
Yeah.
Oh,
like,
I guess I never thought about doing a
like
income statement as an individual.
if you're taking W-2.
Yeah.
But if you're taking a small salary and tons in distributions, being able to explain that and give them some information is going to be helpful, right?
Yeah, that makes sense.
If you have a really strong W-2, that won't really matter.
Yeah.
Sometimes it's just about having the right connections.
Mm-hmm.
Some banks might be more apt to do a home equity line of credit than others.
Yeah.
Right. And it might be more in what their business is and the time in the season and times where there's huge appreciation and a lot of equity in homes. You're going to find it to be a lot easier to get done.
Any final tricks to the trade of HELOCs?
Build actual peace of mind funds that aren't reliant on this. So, you know, this is savings accounts.
Gotcha.
This is cash value.
So don't let the HELOC be your...
This is gold. You know, having that be very helpful. And then you can use this line of credit as something that's secondary, but not your primary.
Because
not
it can...
because it could go away.
Could go away, gotcha.
Right? And then, again, we want to use it for purposes of cash flow. Right? Because what if you're getting in trouble and now you're borrowing more and more? You're now putting that at risk.
Yeah.
So that's the thing. And, you know, just manage it, mitigate risk by looking at, like, what can you do to pay this off? Some people love the strategy, sometimes called velocity banking.
Yeah.
Right? Or HELOC buy downs, where they basically use a credit card to float the bank's money. They put all their expenses on a credit card.
Mm-hmm.
They put all their income to the HELOC. So maybe it starts out at $1 million, and then maybe they make 20,000. So now it's at, you know, 980,000, and that saves them interest for 30 days, right?
Yeah.
Well, this is paying zero interest. They're floating the credit card. Then they pay off the credit card with the HELOC, so they don't pay that interest for 30 days, and they save that interest. It's basically doing to the bank what the bank's been doing to you the whole time. So there's people that build spreadsheets. There's people that have software. There's people that live by that, and they could say, hey, you could pay this thing off 5 to 7 years faster. Some people, if there's bigger incomes, they say you could pay it off in 5 to 7 years. But again, variable interest rates, that needs to be into consideration. If they cut down how much are available to you, that's another consideration before you just put all your money towards this.
So first, what's your opinion on velocity banking?
I wouldn't do it personally. If people have plenty of other cash, totally fine with it. If it's their only way to pay off a mortgage and they don't have some type of all-in-one mortgage, or they don't have some type of fixed interest rate that they can get. I mean, it's been horrible for people that if they started this in 2021, 2022, as interest rates have gone up, it's probably less risky starting it today as interest rates are being cut and going down. But there is these variables of, we don't know what the economy is going to be like in the future. We don't know what the Fed's going to do in the future. We don't know what these banks are going to do if homes lose value and they start to cut those. So there's just risk to it. So can you manage that risk? Can you mitigate it? How responsible are you? It's definitely a possible strategy, not one that I personally use, but it's useful.
When I Google search Garrett Gunderson and it comes with Rockefeller method, almost without fail, there's always velocity banking attached to it.
Right. I got a 30-year mortgage on a jumbo loan, but I was able to get it for 2.75% for 30 years.
Yeah.
I
Locked.
know in my cash value. Yeah, locked for 30 years. I know in my cash value. I know I could do better than 2.75, right? So I continue to grow my cash value while minimizing my payment on this, on the loan. If I would have, at the time I bought my house, 2021, August of 2021, I probably could have got a 2% home equity line of credit as a first.
Yeah.
What would that interest rate be today?
8%.
8%.
So if you were doing velocity banking.
Yeah, because their argument is, Weston, that payment, if I pay $10,000, guess what? That first month, only like, it's basically like $9,990 is going to interest, right? But 15 years down the road, it's like, oh, 5,000 is going to interest, or to principal, 5,000 to interest.
Yeah.
And then those last years, it's like reverse, right? That last payment's like $9,990 payment and, $10 of interest. So these people's argument is like, well, look, it's all front end loaded on the interest. My argument is called cost of money. Can I earn 2.75% or greater? The answer is yes. Am I disciplined enough to take that difference and invest it? The answer is yes. Do I like having 2.75% instead of today's interest rates? The answer is yes. So do I care that I'm paying $10,000 interest on that first payment? No, because I plan on staying there for a long time. And by the way, here's what they're not telling you. If I had, let's say that $500 goes to principal, right? That's $500 at whatever interest rate I can earn. Let's say it's 5% over 30 years. Guess what that's going to grow to? Greater than how much I paid in interest, because I'm earning more than I'm paying. See, we always have an interest cost. There's always an interest cost. Here's the interest cost. I either pay the bank interest, right? Or I lose the opportunity to earn interest on my money.
Oh, gotcha.
Right? What can I earn versus what do I pay?
Yeah.
So, if I know I can do better than 2.75%, I'm going to have more money in the future by having a mortgage. If my mortgage is at 7% and I can only earn 5%, I know I'm going to do more by paying off the mortgage, right? I'm going to save more than I earn. So it all depends on your cost of money. Your cost of money is your highest rate of return that you can sustainably earn. Now, it might be the highest the rate that you have to pay. I have a credit card that's 30%. If I had a balance on that, that's costing me 30 cents on every dollar that's on that.
Yeah.
$1.30. That's a huge cost. I would rather pay that off than invest, right? But again, if I'm at 2.75%, I'd rather invest than pay it off. And plus, I have a mindset. My mindset and my wife's mindset is if we have the cash to pay off the mortgage in a relatively safe place, we consider it paid off even if we have the mortgage. Meaning, let's just say hypothetically I owe $1 million, paying 2.75, but I have $1 million in my cash value, earning 5%. We consider that we could pull this off the next day, pull it out and pay this off. So we have the peace of mind knowing that we're making more money than we're paying and we keep it. And so the reason why people they're confused about this is amortization, because it goes like this. You're paying higher interest up front and then less, right? Interest paid goes like this over time, higher to lower. But even though there's less money that could be invested, money that's invested that went to principal, if you could invest it, higher to lower, lower to higher, meaning opportunity cost. What does that grow to, right? Compound interest. Everybody talks about compound interest. How if you just $10 30 years ago could grow to thousands of dollars today versus thousands of dollars today, only having 10 months doesn't really grow much. And so even though it's a smaller amount of money, there's more time for it to grow. There's more opportunity for compound interest. And this is what most people miss out on, because all they look at is how much money you're paying up front on an amortized loan, not the difference between principal and interest. And what if you could just invest that difference? What would that look like? Well, because of opportunity costs, it goes back to we always pay an interest, whether we use our own money and we don't earn interest, right? Or whether we borrow to keep our money
and pay
so
interest.
We can earn interest, right? It's either you're always paying interest, either forfeit the right to earn it or you pay the bank. The question is, which is greater? And for the masses, for most of the population, they pay a higher interest rate by borrowing than by just actually investing. Because most people, they're investing in CDs and money markets and bonds, and they're in, extraordinarily, highly asset allocated type of funds, and there's a lot of people like, I would rather pay off a mortgage than to put it in an index fund. The index fund is going to be up and down, and even over 30 years, it's more likely that the index fund earns more than what I would have paid. I just like the peace of mind because I don't like the volatility and I don't know what's going to happen with the disruption of AI and technology. So peace of mind is part of the return. So we have to consider all these kind of things. But here's the easiest analogy. Weston, if I'm willing to lend you money and I'm going to charge you 0% interest, how much do you want?
0% interest?
Yeah, no interest.
I'll take as much as you can give me.
All right. All of it. Right? You know what Dave Ramsey said? You take 0. Just so you know.
That sounds like a Dave Ramsey thing.
How fast do you want to pay me back?
How fast do you want me to pay you back?
It's up to you.
As little as possible.
Slow and little as possible. Why did you answer those two questions that way?
Because I could definitely make more money than 0% interest on anything.
Yep. You can make more than 0%. If I was going to lend you money at 20%, how much do you want?
Very little.
Right? You'd have to, how fast do you want to pay me back?
As quick as possible.
Right. Because of opportunity cost.
Yeah.
Because of your cost of money. So it just depends on who you are. If we look at Michael Saylor, he's willing to borrow and he gets to borrow at like really low interest rate. And he puts it into Bitcoin against his company stock. And he's a multi-billionaire.
Yeah.
But most people are saying, never borrow, pay it off, never have a mortgage. It comes down to you. What do you want?
Yeah.
How does that impact your mind? What do you desire? Like some of the things to consider is inflation. Inflation helps you with a loan.
Yeah.
Feels like less and less of a payment every year.
Yeah.
Taxes is a consideration, not the main consideration. You know, cash flow, that's another consideration. Opportunity cost, where else could you put the money? You know, the duration, how long are you going to be in the house and do you plan on staying there? Like there's a lot of factors.
Well, and also just even employment type, right? If we're talking about business owners, it makes
Right.
more sense for them to use that money to create a cash flowing asset versus
Right.
if we're talking about just a W-2
Because we're looking at financial independence, right?
Yeah.
Where we have on our balance sheet, assets versus liabilities, and on an income statement, income versus expenses. We want our assets to create more income. When it's only us creating the income, then it's only coming in while we're working.
Yeah.
When it's our assets, it's working even while we're asleep, even while we're not working. Sure, we're going to manage it and maintain it. But the reality is, if your assets can cover your expenses, if the income from your assets takes care of 100% of your expenses, you're financially independent, which means your active income doesn't have to go towards your expenses. Your active income can build more assets. That's a 10 times advantage. Everybody else is trying to save 10% of their income, right? They're trying to wait and get a 10% return, 10% of the income, 10% return. They wait for 30 years. No cash flow, lots of stress.
Yeah.
I want 100% of your cash flow from assets, allowing you 100% of your active income to actually build assets.
Yeah.
That's the 10x advantage.
Okay.
And so, again, it comes down to who are you? How do you want to invest? What level of work you willing to put in? A lot of people, that's just not what they want to do. So lines of credit, variable, you know, maybe liquidity, depending on if they cut it or not, you know, depending on how much effort it is to go get that. And ultimately, what will the interest rates be in the future? Those are the considerations, but it is a good idea as a secondary tool to help you have access to capital, especially when it's needed. You want it before it's needed, not right when it happens.